Tier 5, selecting the optimal strategy. Cluster 1, how to trade long calls. This presentation is trading in the money calls. Now before we get started, I need to point out that options are not for everyone. You should read characteristics and risks of standardized options before trading. You can get a copy of that by calling 1-888-OPTIONS. That's the home of the Options Clearing Corporation. The job of a trader is to maximize his or her opportunity. There are many different strategies out there, and each strategy is best suited for a very unique market situation. Therefore, traders must match their strategy to their forecast. Now, it's not just finding the best strategy to suit a particular market situation, a particular forecast, but once we select a strategy, we also must select the appropriate month and strike. Now, this particular presentation will discuss trading long in-the-money calls. An in-the-money call is a call where the stock price is above the strike price of the option. In-the-money calls are more expensive than both at-the-money or out-of-the-money calls. They have intrinsic value, and they also have time value. In-the-money calls have high deltas. That means they move rather well in step with the stock. The amount the stock goes up is going to be pretty close to the amount the call goes up. In-the-money calls also have low time decay relative to at-the-money calls. They are a pure stock substitution play, the best stock substitution play that can be created with an option position. This diagram compares out-of-the-money call, at-the-money call, and in-the-money call premium. As you can see, in-the-money calls have the greatest premiums and therefore the greatest potential loss compared to their brethren out-of-the-money and at-the-money calls. Because with options, the most you can lose is what you pay for the option, and because with in-the-money calls they have greater premiums than at-the-money or out-of-the-moneys, they also have a greater potential risk. There's more at stake if the market goes drastically against the trader. Now, taking into account all the characteristics we've just discussed about in-the-money calls, we can observe that they are ideally suited for trading a slow trending stock. The objective is because in-the-money calls have a very high delta. If the stock moves up just a little bit, as it does with a slow trending stock, the trader can capture a great deal of that move. He can participate a great deal in the profits of the trade when the stock goes higher because of the delta. You get that immediate participation. Now, characteristics of options that are not as prevalent here within the money calls, such as time decay, help make it a better suited stock substitution play because it acts more like stock, not just because of the delta, but because it doesn't have that time decay feature as dramatically as an at-the-money call has. A chart like this would be ideally suited for an in-the-money call candidate. We can draw a nice little upwardly trending support line connecting some low points on this chart. If we believe that this trend will continue, it would be an excellent candidate for an in-the-money call. When we look at an option chain like this one of Coca-Cola, when I took this screenshot, the stock was at 68.31, and so the in-the-money calls would be those who have strikes below 68.31, like the 67.5, 65, 62.5, and so on. Now you might notice that the values, that is the bid and the ask, the values of these in-the-money calls are higher than they are of the out-of-the-money calls, those with strike prices above the current stock price. And the lower the strike of these calls, that is, the more in the money these calls, the greater the value of the options. Now, the benefits of using an in-the-money call in this particular example are that it has a high delta and therefore it moves well in step with the stock. You start making money right away. As soon as the stock goes up just a little bit, we're showing a profit on our call. We have low time decay relative to at-the-money options, so it acts a lot more like stock and it doesn't have a lot of that other optionality. Now, of course, some of the detriments of using an in-the-money call are, well, kind of the same thing as the first bullet point goes. It moves pretty well in step with the stock. It has a high delta. So if the stock goes against the trader and the stock falls, the trader can lose a great deal as well. There's greater premium at risk than there is with at-the-money or out-of-the-money options. Therefore, if there's a big move to the downside, the trader can lose quite significantly. Again, it's very similar to simply owning the stock. Market goes up, we make money. Market goes down, we lose money. And that's about how I can best describe an in-the-money call. So each unique market opportunity demands a specific option strategy. We discuss here market scenarios that are best suited for an in-the-money call. This has been a presentation of Market Taker Mentoring, LLC.